1. Introduction. Trading is a psychological business in the financial world where every decision carries a price tag. Most traders make the same critical mistake. They obsess over systems, chase better indicators, and study charts to exhaustion, yet ignore the one element that determines every outcome: themselves. It is not the market that beats them, it is their own mind. Trading is not a numbers game, it is a psychological war. Every click of the mouse is not just a transaction, it is a reflection of a mental state. Fear, greed, hope, doubt, they do not come from the market. They come from within. The market merely amplifies what already exists in you. Wall Street does not pay for emotions. The market does not care if you are confident or terrified. It responds only to action, not intention. While you are trying to read the chart, the market is reading you. The best traders are not the best predictors. They are the best regulators of their own impulses. Every trader walks into the market with emotional baggage, personal history, childhood beliefs, unresolved fear, ego. All of it leaks into trading decisions. How you manage losses, how you handle risk, how you react under pressure. It is never just about price. It is about psychology. The market is a silent battlefield. The enemy is not external, it is internal. It lives in impulsive trades, in broken rules, in every click driven by hope rather than logic. Controlling the market is impossible. Controlling yourself is essential. This business does not reward the emotionally fragile. It demands clarity, discipline, and brutal self-awareness. Machines can compute faster, algorithms can optimize better, but nothing outperforms emotional mastery. Your true edge in the market is not a software, a strategy, or a setup. It is your mind. Recognizing this is the first step to breaking the cycle of repeated mistakes. When you treat trading as a psychological craft, you stop reacting and start executing. You move with precision. You act like a professional. Wall Street does not forgive weakness. Either you sharpen your mental game, or the market will exploit every crack in your discipline. Lessons from clinical psychology. Successful trading requires more than pattern recognition or risk management. It demands an understanding of the self. This is where clinical psychology offers critical insight. Like patients in therapy, traders often operate under the influence of unconscious patterns, reactions formed long before they ever looked at a chart. In therapy, recurring behaviors are not random. They are expressions of unresolved emotions and conditioned responses. The same is true in trading. If you keep violating your stop loss, overtrading, or hesitating on valid setups, it is not just poor discipline. It is deeper. It is psychology running on autopilot. Clinical psychology teaches that awareness precedes change. Before you can fix a behavior, you must understand its origin. What triggers your fear of missing out? Why do you double down after a loss? What makes you freeze when the perfect trade sets up? These are not technical flaws. They are emotional reactions rooted in memory and belief. A therapist looks for patterns. Traders must do the same. Not just price patterns, behavioral ones. Do you always overtrade after a big win? Do you cut profits too early when you feel unsure? These are mental habits, and they repeat unless addressed. Self-reflection is not optional in trading. It is the foundation of improvement. Clinical tools like journaling, thought tracking, and emotion labeling can be adapted to the trading desk. Write down your mental state before every trade. Record the emotions that arise during market volatility. Reflect on how you felt after each outcome. Over time, this data becomes more valuable than any chart. Psychology does not just diagnose problems, it provides solutions. Exposure therapy teaches that the mind can unlearn fear through controlled experience. Traders can use similar techniques by replaying market scenarios, reviewing losing trades without judgment, and slowly conditioning themselves to act with clarity under pressure. Another powerful concept is cognitive restructuring. Traders often carry distorted beliefs, ideas like, "I must be right," or "I cannot afford another loss." These thoughts sabotage performance. Clinical practice replaces them with functional beliefs. In trading, that means internalizing truths like losses are part of the process, or my job is to execute the plan, not predict the future. In both therapy and trading, the goal is not perfection, it is progress. It is not to eliminate emotion, but to channel it. Emotional control does not mean suppression, it means awareness without reactivity. The ability to feel fear but still follow your edge, to notice frustration but not act on impulse. Clinical psychology reveals that most self-sabotage is not logical. It is emotional. And if you treat trading as merely a technical game, you will never see the hidden forces working against you. Only when you confront the mind behind the strategy can you begin to operate at peak performance. In the market, as in life, unexamined behavior repeats. And in trading, repetition without awareness is expensive. Clinical psychology offers the tools. Trading demands the courage to use them. 3. Restructuring the trading mind, most traders try to control behavior by force. They push harder, suppress emotion, repeat affirmations, and build rigid rules. When that fails, they blame discipline. But discipline is not the root issue. The real problem lies in structure, how the mind is wired to respond under pressure. Unless that structure is rebuilt, the trader stays trapped in cycles of inconsistency. Restructuring begins with awareness. Not general awareness, but precise, moment-to-moment observation. The trader must become both participant and analyst. When you hesitate to enter, when you chase a move, when you freeze in a drawdown, those are data points. Your reactions are not random. They are patterns formed over years, reinforced by repetition. The market exposes those patterns in real time. It does not lie, and it does not pause. It puts pressure on your internal systems, beliefs, fears, assumptions, and amplifies their effects. The only way to change those responses is to map them. Track what you feel before, during, and after trades. Track what thoughts arise when your system says buy, but your instincts scream wait. This is the foundation of restructuring. Emotions are not the enemy. They are feedback. Every spike of anxiety, every burst of euphoria, every urge to override your plan is a signal. It tells you where your system is misaligned. Instead of resisting it, you study it. You learn the architecture of your mind under fire, and then you adjust. Rewiring mental responses requires consistent exposure and reflection. The trader needs to simulate stress, review decisions, and condition a new default response. The same way a pilot trains for emergencies, the trader trains for emotional volatility. Breathing slows the nervous system. Scripting internal dialogue prevents mental drift. Reviewing trade footage builds cognitive resilience. None of this is theory. It is psychological engineering. There is no such thing as a system that works if the mind running it is broken. Most traders spend years refining entries and exits while ignoring the operator. They optimize indicators while their internal framework remains chaotic. The true edge is not in your chart setup. It is in your mental setup. Restructuring the trading mind also means redefining success. Most equate it with profit, but real success is consistency under stress. It is executing when uncomfortable. It is trusting the process when results are uncertain. This shift in mindset from outcome-driven to process-driven is the mark of psychological maturity. Language plays a role too. Traders must change how they speak to themselves. Replace, "I hope this works," with, "I trust my plan." Remove, "I cannot afford to lose," and install, "Losses are data." Your internal dialogue shapes your external execution. Precision in language leads to precision in action. Lastly, restructuring requires patience. Psychological change does not happen in a week. The brain resists rewiring, but with repetition, self-observation, and deliberate emotional training, it adapts. What once triggered panic becomes manageable. What once caused hesitation becomes instinct. The trader does not eliminate emotion. They train it to align with execution. This is not soft work. It is the hardest work. It separates professionals from amateurs. Systems can be copied. Edges can be stolen. But a trained mind cannot be replicated. It is the only true competitive advantage in trading. 4. Emotions as data, not enemies. Emotions are not the problem. The problem is misinterpreting them. Most traders treat emotions like threats. They try to suppress fear, ignore anxiety, and fight frustration. But suppression is not control. It is blindness. And in trading, blindness is expensive. Emotions are data. They are signals from the mind. They carry information about internal conditions that often precede behavioral mistakes. Fear is not weakness. It is a warning. Excitement is not momentum. It is a red flag. Frustration is not random. It is a sign of misalignment between expectations and reality. When treated as data, emotions become tools. They can reveal when confidence is authentic versus when it is ego. They can expose hidden risk aversion masquerading as discipline. The emotional response to a trade can tell more about the quality of the decision than the outcome itself. A winning trade entered with fear and doubt is a problem. A losing trade, executed with clarity and control, is progress. The key is to observe without judgment, to feel without reacting. Emotional detachment is not numbness. It is the capacity to process the emotional message without letting it hijack decision making. This is the trader's edge: calm in motion, clarity in chaos. The human brain is designed for survival, not for trading. It reacts to uncertainty with discomfort. It equates financial loss with physical danger. It amplifies the need to act when the correct move is to wait. These instincts kept ancestors alive. They destroy traders today. To succeed, the trader must train the mind to read emotion, not obey it. Practical steps begin with labeling. Give the emotion a name: fear, greed, hesitation. Once labeled, it loses intensity. Next, trace the thought pattern behind the emotion. Are you afraid of losing money or afraid of being wrong? Are you excited because the setup is valid or because you want revenge for a past loss? This decoding process transforms emotion into data. The next step is response conditioning. Instead of reacting, insert a pause. Breathe, evaluate, respond from strategy, not from state. Over time, the brain adapts. The emotional signal still fires, but the reaction becomes trained. This is emotional discipline, not avoidance, but management. Emotions also reveal psychological blind spots. Recurring fear may point to overexposure. Chronic frustration may indicate unrealistic expectations. Elation after a win often signals ego attachment. Each emotion is an invitation to deeper self-auditing. Advanced traders run emotional diagnostics alongside technical ones. They know their emotional baseline. They can sense when something is off even before it shows in results. They act early. They recalibrate. This level of self-awareness is not natural. It is built through repetition and reflection. Technology cannot replace this work. No algorithm can tell you why you ignored your plan. No chart can explain why you chased a move you swore you would avoid. Only emotional intelligence can close that gap. Traders who fear emotion will always be controlled by it. Traders who read emotion turn it into signal, and signal is what drives edge. The market will always change. Volatility will rise and fall. But your ability to use emotional data as part of your decision process is what keeps you adaptable, accountable, and in control. 5. Common self-sabotage scenarios. Self-sabotage is not accidental. It is predictable. It is repeated. And it is almost always rooted in unexamined beliefs or emotions. But traders do not blow accounts because they lack knowledge. They blow accounts because they act against knowledge. The sabotage is internal long before it becomes financial. The most common pattern is revenge trading. A loss triggers frustration. That frustration morphs into urgency. The trader abandons their plan and enters impulsively, chasing the illusion of recovery. It is not about the market. It is about restoring ego, and it usually ends in deeper loss. Another form of sabotage is overtrading, not from opportunity, but from discomfort with stillness. Silence creates tension. Inaction feels unproductive. The trader trades to soothe boredom or anxiety, not because there is an edge. These trades rarely follow rules. They serve emotion, not probability. Hesitation is a quieter but equally destructive force. The setup is valid, the analysis is clear, but the trader freezes. Fear of being wrong overrides logic. They watch the trade move without them. The regret compounds. Hesitation becomes avoidance. They miss trades not because the market is unclear, but because the mind is loud. One of the most dangerous scenarios is abandoning a system after a small string of losses. The trader mistakes variance for failure. They override process to chase new strategies, new indicators, new shortcuts. This is not adaptation. It is desperation disguised as logic. Jumping systems prevents feedback. It makes growth impossible. There is also sabotage through size. Traders increase position size without justification. They feel confident after a win. They want to accelerate gains. But size amplifies emotion. Emotion distorts judgment. The trade becomes personal, and personal trades rarely follow plan. Size without reason is risk without structure. Some sabotage is subtle, like tweaking a plan mid-trade, adjusting stops, extending targets, rationalizing exits. The trader tells themselves they are being flexible. In truth, they are avoiding discomfort. The change is rarely strategic. It is reactive, and it costs consistency. Then there is the classic cycle of all or nothing. The trader loses, then steps away entirely, or wins, then feels invincible. There is no center, no discipline, no measured process. They operate on emotional extremes, not statistical understanding. This cycle keeps them stuck in mediocrity. Underneath all sabotage is one truth: the trader is not managing behavior. They are managing emotion with behavior. Every action is an attempt to reduce tension, reclaim control, or repair self image. The market becomes a mirror. It reflects whatever the trader has not resolved internally. Identifying sabotage starts with brutal honesty. When a trade violates your rules, ask why. When you skip a setup, ask what you were feeling. When you act on impulse, write it down. Patterns emerge. Awareness increases. And only then can change begin. No trader is immune. Even professionals feel the pull of sabotage. The difference is they have systems in place to catch it early. They do not trust feeling. They trust feedback. They follow structure when it is most uncomfortable. That is what separates career longevity from emotional burnout. The market rewards clarity. Sabotage thrives in fog. If you do not make your decisions from process, you will make them from pressure. And pressure without structure leads to collapse, not occasionally, consistently. 6. Trading as a path of personal growth. Trading is more than a profession. It is a mirror. Every chart you analyze, every decision you make, every moment of hesitation or impulse, it all reflects the person behind the platform. For those who are willing to look closely, trading becomes a path of personal evolution, not just financial return. Growth does not begin with capital. It begins with character. The same mind that manages risk also manages relationships, habits, and discipline. A trader who cannot follow a plan on the screen often struggles with consistency in other areas of life. Trading does not create dysfunction. It exposes it. The markets test traits that few professions demand: patience without passivity, confidence without arrogance, discipline without rigidity, flexibility without chaos. Each trade becomes a psychological drill. Every loss is a test of ego. Every win is a test of humility. Real growth happens when a trader stops asking, "How do I make more?" and starts asking, "Who must I become to trade better?" That shift rewires the process. They begin to track mindset alongside metrics. They review not just charts, but choices. They journal reactions, not just results. Developing as a trader means facing discomfort, not avoiding it. It means leaning into fear, sitting with uncertainty, and resisting the urge to escape through impulsive action. Most people avoid their inner world. Traders cannot. Their equity curve depends on it. This path forces clarity. It reveals how you respond to pressure, how you handle boredom, how you deal with chaos. Trading becomes less about market mastery and more about self-mastery. Not in theory, in real time, under stress, with capital on the line. As the trader matures, they begin to value process over outcome. They realize that following a plan in a losing trade is more valuable than deviating in a winning one. They learn that real freedom comes from structure, that clarity is not the absence of emotion, but the ability to act with precision despite it. Growth also requires acceptance. Not every trade works. Not every day will be optimal. Not every setup will trigger. The trader learns to respect randomness, to separate performance from identity, to detach self-worth from a single result. This is where confidence stabilizes. This is where resilience builds. The most successful traders are rarely the most aggressive. They are the most self-aware. They know when to step in. They know when to step away. They know how to recalibrate, not just their systems, but their state. They do not chase perfection. They pursue alignment between mind, method, and market. Outside of trading, these skills compound. Improved emotional regulation, clearer decision-making, sharper self-reflection, better stress response. Trading forces a level of internal accountability that most people never develop. And that growth becomes transferable into leadership, relationships, and every high-stakes environment. Trading is a craft. But more than that, it is a mirror and a teacher. It shows you your limits, your tendencies, your blind spots. And if you are willing to study yourself as closely as you study the market, you will not only become a better trader, you will become a more centered, more resilient, more effective version of yourself. 7. Real case studies and market psychology in act. Trading theory is meaningless without context. Charts do not breathe. Numbers do not panic. Indicators do not feel regret, but traders do. That is why the most powerful lessons come not from models, but from real traders in real situations where pressure distorts clarity and emotion challenges discipline. A trader begins the week with a strong plan. They identify key levels, set clear risk parameters, and commit to patience. The first trade of the day is a small loss, well within plan. But internally, it stings. Not because of the money, but because of the identity hit. The trader thought they had seen the setup perfectly. Ego is bruised. They enter the second trade quickly. The setup is questionable. It is not on their A list. They justify it with vague logic. What they are really doing is chasing validation, not edge. The market punishes the error. The second loss hits harder. Now emotion escalates. Revenge mode kicks in. Position size increases. Risk rules blur. The third trade is pure impulse. It fails fast. The trader exits with a large loss, financially and psychologically. They did not lose to the market. They lost to the internal loop of unprocessed emotion. This is not rare. This is common, and it is entirely preventable. Another case, a high-performing trader hits a hot streak. Win after win builds confidence. Performance metrics confirm edge. But underneath, the trader starts to feel untouchable. They increase size gradually, stretch targets, take setups slightly outside the system. The market tolerates the drift until it does not. One large loss wipes out the past 5 gains. Post-loss, the trader becomes cautious. They pull back size. They skip valid trades. The hot streak is gone, replaced by hesitation. This is not strategy. It is psychological residue. The mind is still trading the past, not the present. Confidence built on outcome collapses quickly. Only confidence built on execution survives. These scenarios are not fiction. They are patterns observed across hundreds of traders over years of coaching and analysis. The specifics vary. The core dynamics do not. Pressure reveals mental habits, and those habits determine the path of your capital. Successful traders study these case studies not to judge, but to recognize. They see their own tendencies mirrored in others. The overtrader, the perfectionist, the avoider, the thrill seeker. Every personality trait expresses itself in the market. The question is whether you see it early or only in hindsight. Breakdowns leave footprints. So do breakthroughs. Another trader, after months of inconsistency, builds a pre-market checklist. Every morning, they assess market context, internal state, and risk parameters. They journal emotions before each trade and review decisions daily. Performance stabilizes, not because they found a better setup, but because they structured their mind. Over time, that trader becomes immune to common traps. They still feel emotion, but they respond instead of react. They lose trades, but they do not lose composure. They win, but do not abandon process. This evolution is not luck, it is engineered through awareness, structure, and repetition. The case studies prove one thing. Success in trading is not a mystery. It is a reflection. The market shows you who you are under stress. And if you learn from what you see, you evolve. If you ignore it, you repeat. Market psychology in action is not about academic theory. It is about real people making real decisions with real money. The lessons are not in the charts. They are in the reactions to those charts. And those who take the time to study them without denial or ego gain something more valuable than an edge. They gain control. #8, tools and techniques for building mental resilience. Mental resilience is not talent. It is not personality. It is a trained capacity built through repetition, structure, and deliberate pressure exposure. Every trader wants clarity under stress. Few have a process to create it. Those who succeed treat psychological training as seriously as trade execution. Resilience begins with awareness. The primary tool is the journal. Not just a log of entries and exits, but a record of thoughts, emotions, and decision context. Elite traders use structured journals to track what they felt before, during, and after each trade. They document hesitation, aggression, confusion, and clarity. Over time, patterns emerge. Data drives adjustment. Another essential tool is pre-market preparation. Not just technical scanning, but mental alignment. A brief written routine where the trader evaluates internal state, fatigue, distraction, confidence. They assess whether their edge is present, whether risk appetite is aligned, and whether emotional bias is creeping in. This mental check becomes a filter. Some days, the best trade is to not trade. Breathing techniques are next. Stress activates the nervous system. It accelerates heart rate, narrows perception, and disrupts rational thinking. Box breathing, used by special forces, resets this system. 4 seconds inhale, 4 seconds hold, 4 seconds exhale, 4 seconds hold. Repeated for 2 to 3 minutes, it restores physiological control. Visualization is another powerful tool. Before the session, the trader mentally rehearses key scenarios, entry triggers, drawdowns, news spike. They see themselves staying calm, following process, executing without hesitation. Visualization strengthens neural pathways. The brain responds to imagined stress like real stress. This is mental simulation without capital at risk. The kill switch is critical. This is a rule-driven, non-negotiable exit protocol. After a predefined number of losses or a sharp drop in focus, the trader shuts down for the day. No exceptions. No revenge trades. It is a system to prevent emotional bleed. It protects capital and, more importantly, protects mindset. Traders must also develop a reset routine. Post-session decompression matters. Whether it is a walk, meditation, or writing a debrief, the purpose is to separate trading identity from personal identity. Without this boundary, emotional residue carries into the next session. Fatigue builds. Mistakes repeat. Self-talk scripting is often overlooked. Language shapes behavior. The trader must install phrases that replace panic with poise. Follow the process instead of, "I hope this works." Take the signal, not the story. Short, directive statements act like mental code under pressure. Repetition makes them automatic. Periodic system review reinforces psychological strength. Once per week, the trader assesses not just performance metrics, but mental execution. Did they follow the plan under stress? Did they act on edge or emotion? Was discipline reactive or proactive? These questions maintain internal accountability. Some traders use audio cues, short mantras, or focused playlists to anchor themselves during volatile periods. Others train decision fatigue resistance by simulating trading conditions outside live sessions. They build mental reps the same way athletes train drills. None of these tools work alone. They must be layered, embedded into daily routine. They must be used before failure, not after. Resilience is not what you turn to when things fall apart. It is what prevents them from falling apart. The difference between an amateur and a professional is not emotion. Both feel fear, frustration, temptation. The difference is that professionals prepare for those emotions. They structure around them. They build systems that catch them early. This is not soft psychology. It is performance architecture. The mind is the first platform. If it is not optimized, nothing else is. And in trading, you do not rise to the level of your strategy. You fall to the level of your mental conditioning. Build it well or pay the price repeatedly. Conclusion. Mental strength is the last great edge in a world of automation, algos, and artificial intelligence. Strategy is no longer scarce. Every indicator is public. Every edge is temporary. Execution speed has narrowed. Informational asymmetry is shrinking. What remains, what endures, is mindset. Mental strength is the final edge. Not just resilience, but adaptability. Not just discipline, but self-awareness. The trader who can remain stable while others react. The one who can execute with conviction while volatility shakes the room. This is where careers are made or erased. Success in trading is not reserved for the smartest. It is reserved for the most consistent. And consistency is psychological. It is showing up prepared, acting with intent, managing risk without hesitation, sticking to process regardless of outcome, trading the plan when it is boring, exiting the plan when it is broken. The average trader seeks the secret. The professional builds structure. The average trader asks what system is best. The professional asks how to think clearly under pressure. This shift defines trajectory. Edge is not something you find. It is something you become. The mind either amplifies your system or destroys it. It turns strategy into execution or confusion. When the pressure spikes, your trades reflect your training. Your outcomes reflect your conditioning. There is no neutral ground. Either your mind works for you or the market uses it against you. Build your edge where others neglect it. Study the inner game. Refine emotional control. Journal the truth. Train mental clarity like you train technical entries. Protect your energy. Review your reactions. Evolve. Trading is not a prediction business. It is a performance business. And in performance, mindset is not part of the game. It is the game. Subscribe to Trading Mindset Lab. If this content speaks to the trader you are becoming, you are in the right place. At Trading Mindset Lab, we do not chase hype. We study behavior. We train clarity. We build structure. No noise. Just tools, off systems, and psychological skill sets used by real traders on real accounts. Subscribe now and get access to the tools that turn confusion into conviction and impulse into execution. Unlock deeper content, live breakdowns, and weekly drills designed to sharpen your trading mind. Because in the end, the strongest chart is useless if the trader behind it is not ready. Trading Mindset Lab. Train the mind. Execute the plan. Own your edge.